Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Today's show is all about taxes. And why not? Because we are moving very close to the income tax return filing deadline. Now, you'd wonder why we're having this conversation now. Usually, it's the 31st of July. That's the red letter day when it comes to your ITRs. But this time, we have a grace period. That deadline is the 15th of September. Therefore, we still have time to quickly get you the best tips for a hassle-free tax filing experience and tell you all that you need to know before you get down to filing your income tax return. So joining us today, two guests. We have Suresh Surana from RSM India and Sonu Iyer from EY to make it all very, very simple. Now, I don't know how the lady and the gentleman will do that because let's jog our memories a little bit. We're all filing income tax returns for FY25. And in FY25, we had not one, but actually two budgets. There was a vote on account, then there was an election, and there was a final budget, and lots of tax changes in between. So thanks so much for joining in, Sonu and Mr. Surana. Let's get your opening thoughts. I'm sure you folks would have been very, very busy across your teams, particularly those members who look at personal taxation. Sonu?
Hi, Surabhi. Good to be back on your show. And yes, we are in the home run. As you said, 15 September is looming large over the people who have to file their tax returns. So in our lingo, it is the tax filing season. So the teams are busy preparing tax returns, making sure that people pay up their taxes and file their returns. So yes.
Yeah. Mr. Surana, it has been complex. You know, when I started also preparing for the show, I realized, so much had changed in July. July of, it was 2024, when we had the final budget come in. We had the capital gains tax change. 10% became 12.5%. And even within the tax regime, the new regime, there were some changes here and there. So, where does one begin when you're talking about the ITR? How do we, put it all together?
Yeah, so I think as you rightly said, there are more than 7 crore, individual tax filers, and 15 September is the deadline for the same. I would say the most important thing first is now there are two, tax regimes. One is the old tax regime and there is a new tax regime. And the new tax regime is more liberal in terms of the tax slabs. Yeah. But at the same time, you do not get some deductions. And each year, you need to select between the two regimes.
Correct.
And you have the option to select each year. At that, even at the time of filing of the return, you can do that. Now, if you look at the two regimes broadly, and I think most people are gravitating towards the new regime. Last year, if you look at 72% people had actually opted for the new tax regime. This year, I think number will go even further. So the basic exemption limit is 3 lakh rupees under the new regime, whereas it is 2.5 lakh under the old regime. Yeah. Then the slabs are from 3 lakh to 15 lakhs under the new regime, whereas under the old regime, after 10 lakh rupees, then you have the highest tax rate of 30%. Then those who are having more than 5 crores of income, the tax rate under the new regime is 39%, whereas the effective tax rate under the old regime is still 42.74%. But you do not get some deductions under the new regime.
Correct.
So some of the important deductions are, for example, interest on housing loan, which up to 2 lakh rupees you can claim.
Yes.
The second is ATC deduction, which is up to 1.5 lakhs.
Yes.
When you make investment in your recognized provident fund or PPF, National Savings Certificate, long-term bank deposits. The third thing which is there is that you have also deduction which are under ATG, for example, which are which is for donation. You have Mediclaim, ATD. All those things you cannot claim under the under the new regime.
Under the new regime.
So you really need to do the calculation under both regime, and then you can select. Absolutely. And you can select each year what basically suits you.
Yeah, absolutely. And that's why it's also important to understand whether this selection between old and new, can it be done even now for FY25? Sonu, the year is over, is long gone, and maybe you decided to be with the old regime, and that's, or your default regime in your office was the old regime or whatever, or maybe it was new, and you suddenly now realize that you want to switch. First of all, what are the big thumb rules if you look at FY25 in which maybe a person is still better off, say, in the old regime, and can they even make the switch now as the return is being filed?
So, Surabhi, if you are a salary income earner, if you have income from other sources, if you have capital gains, essentially non-business income cases, you can, switch anytime. So even if the employer has been withholding tax as per the new tax regime, if you decide on comparison, old tax regime is more helpful, So you can switch on to the old tax regime at the time of filing the tax return. So for non-business income cases, this switch on and switch off can happen anytime. They can do it at the time of filing the return. They can opt out each year and opt in every year. They can change their mind. But I think people who have income from business and profession, if they want to opt out of the new tax regime, because that's the default tax regime, if they want to opt out of this new tax regime, they have to actually file a Form 10IEA to the tax authorities before they can file their tax return. And you need to quote the acknowledgement number of this Form 10IEA in your return form. So for them, it's only an option that's available after filing this form. And then say in a subsequent year, they want to get back onto the new tax regime, they can make this change only once in their lifetime. So unlike the salary income and income from other sources, capital gains income taxpayers who can do this switch every year, it's dynamic. But for business income, this can happen only once in lifetime. After you've made one choice earlier, then opting back in can only be once in your lifetime.
Okay, important clarification there that you can still do all your calculations with all the types of income that you've earned during the year and still decide to switch if you're largely a salaried tax person between the old and the new. Which brings us to the next question.
And maybe another tip, sorry, so another tip on this because it's important and your viewers may want to know how do we know which is better for us. So income tax portal actually gives you a calculator. You go on to the income tax portal under tax information services, you get the tax tools. You have the first is the calculator, which shows you which regime is better for you. You can input your income details and you have the answer. So it's easy.
Okay. All right. So that would be very, very helpful. Absolutely. Now let's, understand what some of these important forms are. Again, if you go on the portal, you will have something known as the Form 26AS. There's anyway the Form 16 if you're a salaried person. Then your employer gives you that Form 16. There is also the AIS, the Annual Information System, right? There is a TIS as well. So, exactly, largely for CAs and tax professionals. But if I want to get a complete picture of my income, how much tax I've paid, and what has really happened in my financial profile in the year, how do I make use of all of these documents, Mr. Surana?
So I think very important what you mentioned because it is you must reconcile before you file your tax return with 26AS and also AIS, which is the annual information statement, and TIS. Now 26AS will contain the whatever income is there which is reported and also tax which has been deducted. So what credit you are claiming must reconcile. Otherwise, you will not get credit when the at the time of processing of the return. So in case, for example, somebody has not uploaded, then you need to reach out to the payer that he must upload that information. Now, AIS actually contains a lot more information. It also contains on in terms of the high value transactions, any investments made by you are also there. Any property transaction will be reflected.
And
there.
all of it is being captured seamlessly now because it's all linked to our PAN.
It is all linked. So you need to see that all those transactions are are captured. One more important thing I would like to say that apart from this, you should also review your bank statements and demat accounts because there may be transactions which you need to report. And so apart from AIS and TIS and 26AS, you
what
should also...
What does TIS tell us?
That is the tax information in terms of, tax information statement, what is tax deducted and other, and also TCS, which is the tax collection at source. So you may have, for example, bonus shares or other things which you all need to capture properly, which may not be financial transaction. Other thing I would also like to say that non-monetary transaction, sometimes people skip that. For example, very common thing is the redevelopment of property. Now, there may not be any monetary transaction, but it may trigger a tax implication. Similarly, you may have gift received from somebody. Now, relative gift is exempted, but non-relative is taxable.
Okay, so gifts from relatives are exempt, but non-relatives taxable.
Taxable. Okay. Similarly, inheritance could be there. So you need to make sure that
But we don't have any inheritance tax.
No, there is no tax, but it may have, because it might impact what you are reporting. Like, for example, the statement of shares. You need to give your shareholding. So those things I think must be captured also. So I would say look at your 26AS, look at AIS, look at TIS, look at your bank statement, demat accounts, non-monetary transactions so that you do correct reporting.
Okay, all right. So make use of all of these documents, and all of them are there on the income tax portal, and you can look at them, revisit them, cross-check them, and then get ready to file your income tax return, which brings us to the next step. Now, which is the income tax form that you need to pick? For those who, actually do want to go ahead and file their own tax returns, 4 key forms that we always speak of: income tax return form 1, 2, 3, and 4. So let's quickly, understand broadly, Mr. Surana. 1 and 2 are for salaried income.
One and 2 is for people who do not have business income.
Okay.
So you may have capital gains, you may have other income from other sources. That is all fine. And 3 and 4 is for those who have business income.
Okay.
That is the
business
first.
income or income from profession?
Yeah, income from profession,
Yeah.
business or profession.
Okay.
That all comes under that one category.
Okay.
So first you decide, are you in ITR 1 and 2 or ITR 3 and 4?
3 and 4 category. Okay.
Now next step is, if you look at ITR 1, which is called ITR Sahaj, which means it is simpler. So while ITR form is simple, but the criteria are not simple. So
It is called Sahaj. It's supposed to be a one-pager form or something like that, right?
So it not as short as that, but I think whether you are eligible for ITR 1 or not is very important. Now, before that, one more very important point I would like to mention, and a lot of people make mistake in that. People think that only if they have tax liability to pay, then they have to file the return, which is a misnomer.
Yes.
So
yes.
if your income is more than the basic exemption limit,
which is 2.5 lakh rupees
under the old regime
under
and
the
3
old
lakh under the
regime
new
for
regime.
FY25, and it's 3 lakh rupees under the new regime.
No, but that also not the taxable income, but it is taxable income before Chapter 6A deduction, which means
Before claiming any deductions. Yeah.
So it is, which again many people miss out.
They miss that.
And secondly, even if tax is deducted, you still need to file the return. And now, for example, rebate is available up to 7 lakh rupees. People don't have to pay any tax. But that doesn't mean that you don't have to file the return. You have to still file the return to claim the rebate also.
Everyone has to file the return.
Yeah. So I'm just saying there is a difference between tax payable and tax filer.
Yeah. So I'm exempt from the threshold, so I don't need to file. So why do I file my ITR? Doesn't apply.
Yes.
Or I've paid all my taxes. My company's already been cutting tax from my salary. So then what do I need to do? You still need to file your income tax
Exactly.
return.
That's very important because many people miss out on this.
No, absolutely, absolutely. So so we were talking about the forms. So as we've understood that 1 and 2 is applicable if you do not have any, business income or any income from profession. Now, a lot of people are actually self-employed. Salaried is one big category, but there's a whole category of people who are self-employed, self-professionals, delivering professional services. For them, how do they go about deciding between 3 and 4? I think 4 is a simpler form, right?
Yeah, so ITR 3 is typically what would be applicable to these people who have business or profession income. Now, ITR 4 will be applicable for individual taxpayers who would otherwise have filed this ITR 1, which is the Sahaj form, but end up having income from business or profession, which they pay tax on presumptive basis. So if you're a small business person, or even if you are a professional where you're paying tax on a presumptive basis, where percentage of your gross receipts being offered for tax without taking any expense deduction, etc. In that case, ITR 4 comes in for people who are eligible for income 1, but they have a business or profession income which is taxed on presumptive basis. But I think what Mr. Surana's point was about the criteria for ITR 1, where most of your taxpayers would potentially be filing tax returns. That is one that bears some discussion, if you allow me to bring that back on the table. Because the criteria, as he pointed out, is not so sahaj. We're saying that, ITR 1 is simplest of all these forms, but there are the 3 basic conditions. You can file ITR 1 only if you are a resident, an ordinary resident for tax purposes in India. And if your total income is up to 50 lakh rupees is there. And then the baskets of categories of income for which this form can be filed. So you have to satisfy all 3 criteria. You have to be a resident. You have to have total income which is up to 50 lakhs. Beyond that, you can't file this form. Plus, you should also be falling in the categories of incomes that are covered. So you have income from salary. You have income from one house property. You have income from sources such as your interest income, dividend income, family pension, and you have income, agricultural income, which is only up to 5,000 rupees. And you have exempt long-term capital gains and, from sale of equity-oriented mutual funds, long-term equity-oriented mutual funds, or long-term equity of units of business trust. So, you can understand just by me calling out all these sub-criterias, the eligibility is the big thing to cross. If you don't fall in any of these categories, then you have to consider ITR 2, ITR 3.
Yeah, so then Sahaj is not for you unless you manage to fulfill some of these critical conditions. Got that. Well, we do have to take a very quick break on that note. On the other side, our experts are going to give out very simple, easy to understand, handy tips when you go ahead and get ready to file your income tax return. And also, we must remember the timelines, the penalties, in case you don't file, what happens then? Back with that in just a bit.
Let's talk money.
Welcome back. Here with us on Let's Talk Money. And this week, along with money, we are talking taxes because it's tax filing season and we need to ensure that our income tax returns are filed by the 15th of September. Actually, just for the sake of understanding, what happens if someone is not able to file by 15th September, if there's a delay or some issue happens? Usually the server always gets overloaded and then there's an extension. But, how does it look, Mr. Surana?
So there are, I would say, three different implications. One implication is that there is a late filing fee, which can range from 1,000 rupees to 5,000 rupees.
Okay.
So that is one part. The second part is there is an interest which may be payable if there is a self-assessment tax which you haven't paid.
Okay.
So even if you are delayed, it is better to pay the self-assessment tax.
Correct.
Because otherwise you pay 1% per month, interest, but even for part of the month. So for example, even if you delay by 1 day, you have to pay for the 1 month.
Full 1% on that
full 1%.
outstanding amount.
Yeah. So better that at least you do a quick calculation, pay your self-assessment tax if you are delayed for any reason.
Okay.
The third thing is that there can be penal consequences because particularly if department issues notice to you before you file the return, they can presume that you were trying to conceal the income. So there can be penal consequences. There is a provision for even the arrest or in terms of prosecution, what we can call.
Okay.
But very rarely we have seen
cases.
that being used. So I don't want to scare anyone. I'm just saying that.
Absolutely. Also, speaking, you mentioned department. I just remembered that refunds are also something very, very important that we all look out for. So Sonu, I mean, at the time of filing your ITR, what about the process of claiming a refund? Can you only claim for the same financial year FY25? What if you realize there was some outstanding amount? Basically, how does the whole refund process work?
So the income tax return is essentially for that fiscal. So, in this case, April 24 to 31st March 2025. So incomes of that year have to be offered for tax. So refund of that year also has to be claimed. There is some allowance in terms of carrying forward TDS from previous years. If you have, say, composite TDS deductions, you can use it in this year. But you can't claim refunds of another year in this year. It has to be per year filing. So therefore, the point you're making about filing your tax returns on time is very important. You have to file on or before the statutory timeline, in this case, 15 September. We can file revised returns up till 31st December 2025. But after that, there is no other window. You would only be able to file updated returns, which in case you've missed reporting something, missed paying taxes, then you have an opportunity to file an updated return, which goes on till 31st March 2030. But the important aspect is, A, to stop the trigger of interest in case the taxes are not paid. Make sure that you file on time. If you have, brought forward losses, make sure you file timely return to be able to claim that.
Okay, all right. So completely listening to you carefully and taking that advice, better to simply file on time or even before time if possible. Which brings us to final thoughts. And now we need to summarize everything to make it simple for our viewers in terms of the key things that we need to think about, surely discuss with our CA and, go ahead for smooth and error-free filing of that tax return. Let me ask both our guests. Mr. Surana, I'll start with you.
So I think some of the points which we already discussed about in terms of making sure that all your income is captured, the TDS, TCS is all captured, you reconcile with 26AS, AIS, TIS, all those things. Look at your bank statement, demat account, non-monetary transaction. Apart from that, also see that in case you have any carried forward losses of the earlier year, you also looked at that. One important point for non-residents is that they must determine their residential status properly, because for non-resident and those who are resident but not ordinarily resident, the income arising outside India is not taxable. So if you have to, and the criteria has become fairly complex in the last 3-4 years. So now it is not simply based on number of days stay in India. You have to also look at citizenship. You have to also look at taxable income. So it is a function of 3 factors. So very important that you also look at what is your residential status. Also make sure that if you have refund, or otherwise also have one validated bank account which you submit the information so that the refund can be directly credited to your bank account. Also make sure that you have PAN and Aadhaar card linked all your, whether it is your, in terms of depository accounts, and those are linked with the mobile numbers so that you get proper intimation. So these are some of the other hygiene checks I would say we should look at.
When you mentioned income from maybe overseas or foreign sources, that got me thinking, Sonu, because, now a lot of retail investors as well, regular investors with salaried income, they have started taking exposure to global assets. They could be doing it through Indian mutual funds, which are investing in US stocks. Many people get, very excited. They end up buying, say, US equities or any other country's equities directly as well, and holding in, in overseas accounts, demat accounts or foreign broker accounts. Now, what is it that they should keep in mind? Maybe they're not booking that profit or booking that gain, but is disclosure important? It might be in small quantities. I want to own 5 Apple shares, 5 Google shares, but what are the tax implications?
Surabhi, I think a great point. The fact that determination of your residential status, and if you are more than likely ordinary resident in India, you need to report all your foreign assets and liabilities. So all your foreign asset, foreign source income needs to be reported. As you said, you may not even have booked any profit. You may not have got any income. But if you have an asset overseas, a financial asset, immovable property, you've set up a bank account overseas, you need to report that. And failure to report even a single asset, would trigger a penalty of 10 lakh rupees. So I think that's the most critical aspect. If you are, foraying into buying assets overseas, please make sure that you're doing the disclosure under the foreign assets and liabilities schedule in the tax return.
Okay, all right. That's really important, and important to keep in mind, because this whole talk about global diversification in our investments, that's a reality. We have been speaking about it on this show as well for a long time. So in case you've managed to diversify your investment base, make sure that you're compliant with all the disclosures. Well, thank you so much, Sonu and Mr. Surana. Great conversation. Thanks for joining in. Very, very enlightening. And we hope it'll help all our viewers file their tax returns seamlessly and on time. Thank you for joining.
Thank you very much. Pleasure.
All right, with that, it's a wrap on this edition of Let's Talk Money. Keep sending us your feedback, comments, queries. We'll see you again next week.
Let's Talk Money